Everyone,
Conference will
so
now be
great to
recorded.
have everyone here. In case you missed it, the Fed lowered the Fed funds rate yesterday by a quarter of a point. There are hints of another quarter of a point when they meet in December, but they appear to be achieving the soft landing we addressed in many of our quarterly economic updates. Welcome to our Q3 economic update, investment outlook. Hey, with the Halloween theme, Shawn and I promise all treats, no tricks. Okay, so hang in there with us. At least last quarter wasn't boring. We hope to give you a general overview of the key issues impacting the US and the global economies. We're focusing on the areas that will impact most of our attendees. A huge caveat and apology. Since we began presenting these quarterly updates, we've relied on sources we believe to be the standard and most accurate. We've always relied on the US Bureau of Labor Statistics for many of our data points. As you may be aware, it was determined that for several months, the Bureau of Labor and Statistics reports were grossly misstated. I'll not address whether this was intentional or not, but many economic decisions are made by businesses and governments alike, and they rely on accurate data. As a result, the commissioner of the BLS was fired in August. To further make some of our unusual data points we cover, uh, since the government is closed, there's no accurate information source. So we'll identify where those things are applicable. Please note your questions in the chat box. There will be ample opportunity in the latter part of the presentations to answer them. Several of you submitted questions in advance, and we will address those as we begin the question portion of the presentation. So let's review a quarter when we actually got some answers to long pending uncertainty and got a bunch more questions. This is just the way life seems to be, I guess. Joining me today is my partner, Shawn McCabe. Together, he and I will strive to make some sense out of the market and the economy. When we had our Q1 economic update presentation just 6 short months ago, the market was beginning to recover from the 20% plus decline. That was from a peak. And within 2 short months, boom, things were crazy. The S&P was at 5,500. Today, we're at about 6,900, roughly a 25% increase in 6 months. But the vast majority of that increase is by 7 stocks, the Magnificent Seven, as they have been referred to. They comprise approximately 40% of the S&P 500. So unless you're invested heavily in the high-flying tech stocks, your portfolio probably isn't up even close to that. But generally in the third quarter, all major indices perform quite well. We have our first trillion-dollar company. What about the other 493, though? We'll explore that imbalance and the impact on your portfolio. We're hearing the B word being uttered much more frequently, bubble. Be cautious. As we always say, turn off the TV and focus on the facts. Along with high reward comes high risk. Periods of high concentration on a limited number of high flyers, like the late 1960s and the early 70s when we had the Nifty 50, were in vogue. And then the late 1990s, we had the tech boom with the Roaring 20, and both of those instances preceded significant declines. So monitor your portfolios closely for high sector concentration. I'll speak more about diversification later. Shawn, is the economy or supporting the market trend, or what have we got going on that side?
There we go. Thanks, Marshall. Well, as they say, we're going to let the data speak for itself. So here we are again, another quarter. And as you alluded, Marshall, the headlines seem as concerning as ever. Government shutdowns, AI bubble talks, softening job markets. Got to take a breath. Tariff talks, the Fed dropping rates, and then being non-committal to a December rate cut. The 10-year Treasury yield pushed back over 4% yesterday. Real estate market softening, yet markets hitting all-time highs. Of course, short of yesterday's pullback on the Fed cutting rates and then being non-committal to December. So before we dive into the data, kind of answering that question directly, Marshall, I just want to echo you. Our best advice to all of our long-term investors out there listening in today is always turn off the TV, hold steadfast, and stay the course. So we hope the following data makes it easier for you to do that and hopefully answers that question, Marshall. These are the main data points we cover each quarter. If you've been tuning in with us for a while, you should be used to this slide. And the reason we do that is because they are the most common metrics that most folks are talking about. And they're used primarily to measure how the economy is doing. The big three, in my opinion, are growth, and we use a measure of real GDP for that, inflation, and unemployment. We'll also check in on the Fed funds rate, interest rates, and of course, political and geopolitical issues as well. Lots of fervor there. Hopefully the data in our commentary will give you the same don't panic demeanor Marshall and I have throughout our day-to-day and our long-term wealth building plans of our own, that is. First up is real GDP. This is the most common metric of how an economy is growing based on spending, right? Caveat here, as Marshall mentioned in the first slide, the government is shut down. So the Q3 data is absolutely estimated. Plus, we all know there were some firings over inaccurate data. So for now, this is the best we've got. GDP growth for 24 came in at around 2.8%. We have 2.9 on the slide. There's been a lot of revisions out there, so I'm going to make a point about that here in a second. GDP contracted for Q1 of 25. It was down 0.6 based on the third revision. I think that happened around the time of the firings. GDP growth for Q2 25 was around 3.8%, again, the third revision. And GDP growth for Q3 25, we have on the slide 3%. I read the Atlanta Fed printed 3.9% or estimated 3.9%. I think the Philadelphia Fed was at like 0.9%. So really, we don't know, but we're thinking somewhere around that 3% mark. Even if it is 3% or higher, you guys can see the trend from Q1, Q2, Q3, and all the way after from 2024, that we're starting to see inflation slightly tick up a little bit. Now, make a great point here, just to kind of hopefully make us feel all better about the exact science versus, okay, what does this data really mean? And that point is metrics don't really make sense without a benchmark or some sort of average or even goal to compare them to. The historical growth rate for the US between 1947 and 2024 is around 3.21%. So let's let that set on a little bit. The average growth rate for the country from 47 to 24 is around 3.21%. Economists, the Fed, most folks in the markets think that anything less than 2% growth is considered sluggish. Even though there have been several revisions, if you look at the data from a broader perspective, instead of an exact science, you definitely can get a gauge for where we are. So from the data perspective, the economy is still growing, AKA people are still spending, government's still spending, business is still making profits. A quick kind of like thought that just popped in my mind, and I know Doge is still out there, and we had a slide in here last quarter, maybe 2 quarters ago, on what Doge has been up to. But I am curious where those dollars are going. So maybe next quarter we'll have a slide in there to update everybody on that. So jumping into inflation as measured by the Consumer Price Index, CPI, otherwise Consumer Price Index, measures the average change over time in the prices that consumers pay for a standard basket of goods and services like food, housing, and transportation. Just keeping it basic. So in 24, the CPI came in at 2.9%. In Q1 25, it was 2.4, Q2 2.7, Q3 3.0. All right, we're starting to see some trends here, right? 2.4, 2.7, 3.0. We're a little higher than where we were in 24 if we're measuring here exact science. So with the Fed's inflation mandate of 2% as this benchmark, right? And if you consider the trend that we're seeing since Q1 and back into 24, the initial softening of the job market, now it may be more easily understood why the Fed decided to cut rates another 25 basis points yesterday. Right, wrong, or indifferent, the Fed is taking a little bit of a proactive approach to, hey, we're seeing inflation tick up, we're seeing unemployment soften. Let's go ahead and make some moves here in reducing the interest rate. I'm not going to go on the record to say there was some political influence in it or not. I don't know, but the rates have been cut 2 25 basis points cuts in the last month or two, and the Fed is pretty much stalling on December. All right, moving into the help wanted section. Speaking of unemployment, with September printing in at, guess what? We don't know. With the government shutdown, BLS not printing out the actual unemployment numbers yet. We left this up here with big question marks. It kind of gives us a little insight too about the Fed's decision to cut rates. If you start to look at unemployment figures, in December it was 4.3, went down March 4.2, June is 4.1. Word on the street, if you will, as they're starting to see a tick up in unemployment. So again, until that data presents itself, we're just going to have to kind of have to wing it. All right. Knowing that the Fed's second mandate is maximum employment, while they don't follow that strict mandate of 4%, they do tend to get a little nervous when reports show rising inflation, and especially when it starts getting above that 4% mark. Again, which is what we saw through Q3. We always like this slide. It's just a visual of the economic cycle. This chart has not moved noticeably since last quarter. The US remains in the late stage of the economic cycle, which basically reflects moderating growth, tighter credit, a little bit of earnings pressure, maybe some increasing inventory levels, and a potential slowing of sales. When you start stacking all that together, companies are still making profits, but their revenue's starting to slow and their profits starting to slow. And that's kind of why the illustration puts the US in that later cycle of the economic growth cycle. But please keep in mind, this illustration is simply just to show where we are in comparison to other economies and where we are potentially in our own economic cycle. Although momentum is our friend, apart from something systematically unforeseen, I wouldn't be surprised to see us stay here through the remainder of 2025 and into early 2026, caveated by, again, an unforeseen systematic change or unexpected retail sales softness figures through the holiday season. So the current Fed funds rate is 4.12%, following 2 quarter-point rate cuts since our last update. With the latest cut yesterday, as Marshall said, the Fed's target range is now 3.75 to 4%. The image on this slide, I always like updating the slide and giving you kind of, what the current update is to go forward, but I left this slide on purpose. It's actually from last quarter when we updated it in July. And take a look at the 2025 column. What you're looking at is, if you look at the 2025 column, the light blue dots are the Fed individual open market committee chairman's opinion of where they think the market rates should be in March. The dark blue is where they think the market rates should be in June. So if you kind of take, without counting them and dividing by the total number, what the average is and kind of just gauge it, it looks like we're averaging around 4% on there, maybe a little less, right? So the Fed sentiment on where they want rates for 2025 back in July was right around 4%, maybe slightly below. That being said, along with Chairman Powell's quick retort yesterday, if anybody was listening in to the Fed comments on the rate reduction, that a December rate cut is far from assured. My opinion is, I don't think the Fed is going to budge in December. But again, time will tell. We'll see what the inflation numbers do. We'll see what the unemployment numbers do, and see how generally the economy is doing. But last point I want to make on this slide is, longer term, not much has changed with the Fed's position for beyond 2025, with a target of 3.4% for 26 and a 3.1% for 27. Obviously, with the Fed longer term is looking to cut rates, they're expecting, kind of looking at that late stage of economic cycle, they're expecting, hey, we may need to reduce rates to spur more economic growth. So let me say this, a lot can happen in 24 months. The Fed is looking to lower rates as we linger around the tail end of the economic cycle. But again, a lot can change. So really, we like to focus on where we're at in the next year or the next couple of quarters. All right. So from a U.S. sentiment on the U.S. economy, this is something that we look at pretty regularly. What is the consumer feeling? And really, if you look at this chart, it puts on a negative, a generally pessimistic stance. This chart is the University of Michigan's Consumer Sentiment Index. Our money manager friends at CPS provided this information. Pretty good the way they perspected and gave it to us. But it's a widely followed index measuring how the U.S. U.S. consumer feels. Anything above 100 is optimistic. Anything below is pessimistic. So just take a look at the chart. I'll let you analyze it for a second. And just look at all the amount of time it's less than 100, right? The point here is fear and greed control sentiment, period. Over the last, this chart goes back to 1978. So, over the last 50 years, the market and the economy and GDP have generally moved into a positive direction. But yet the consumer, for the majority of the time, is pessimistic on our economy. Again, driven by fear and greed, purely. And that fear and greed is driven mostly by factors that the news portrays. So I'll ask you this, kind of ending up my point here on the economic side of things. Based on the economic indicators we just covered, Marshall, this is going back to answer your question. Does it feel like the economy is where we were during COVID, the great financial crisis, or even the dot-com bubble / tech wreck after they occurred? It doesn't, does it? To me, it doesn't. According to this study, many consumers feel that way. And the current print is at 58.2. It's one of the lowest times it's been in a long time. Why the disconnect? My answer again, the media. Drama sells. Negative news sells. Human nature loves to take in and gawk at a lot of things we don't see every day, negative things. Perfect case in point, think about I-95 fender benders. No real issue. There's one cop on the side of the road, but the miles and the traffic is 3 or 4 miles backed up. All right. Hopefully you get the point. So I'll leave it there. Marshall, how are we looking at the geopolitical and political front?
Well, it's interesting. Starting with the geopolitical side, other than the Hamas versus Israel peace accord, not much has changed in the last quarter. The Russia, North Korea versus Ukraine conflict wages on, causing humanitarian issues and creating more risk to investors' capital to flow in the region. While world leaders are optimistic about the conflict and that it is contained, there's always risk of escalation, and you hear a rumor of spilling over to other countries, if you will, and increased tension between Russia, NATO, and of course the West. As noted, Ukraine and U.S. relations have been strained during the new administration. We hope that's healing to a degree. However, by my calculation, President Putin is flirting with various Trump-imposed deadlines, and you just never know exactly where it stands. It's tough to get a good read on how it's going. Hamas and Israel appear to be peaceful for the moment. I'm excited. I have an appointment today with one of my clients in Israel. I'm looking forward to his firsthand opinion of current conditions. It's always helpful that you don't have to rely on the media. You can rely on someone who actually lives in Israel. U.S. and China are in full economic war through the use of tariffs. But as of yesterday, at least they're talking. That's a good thing. So we're hopeful that cool heads can prevail on the U.S.-China tariff battle. U.S. and Venezuela is a new one. They're having a battle of drug cartel operations. I don't know where that's going to end up, but it's a new one on our radar for geopolitical tensions that we're monitoring. So lots of tense areas globally. I suspect it will continue through the remainder of the year and well into 2026. On the political side, hey, U.S. government is closed. You're talking today, there's 2 of us who deal with the IRS and various government agencies on a regular basis. And it's really challenging when the people you need to talk to are on furlough. So hopefully the cooler heads will prevail on both sides of the aisles and get the government back open and functioning. It's interesting how we learn how much government impacts our lives and how little government impacts our lives when you don't have them for a month. So it's a good check to see, okay, what do they really do up in DC and what do we really need them to do? Unfortunately, the best thing they seem to be able to do is spend money. The U.S. debt continues to run rampant and unchecked. I think we're crossed 37, headed to 38 trillion now. Hey, petty cash. I'm sure there's a box with all that sitting around somewhere. And I couldn't let this presentation go on the political tensions without referring and referencing Charlie Kirk. I'd be remiss if I didn't acknowledge his assassination and comment that this is a great loss to the youth of America.
Yeah, definitely a great loss, Marshall. Thanks for mentioning that. So Marshall and I decided to keep this slide in here for one more quarter as we get close to the end of the year for those interested in doing some tax planning, hopefully everybody. So if you'd like to go back and view our short video on the highlights of the One Big Beautiful Bill, feel free to scan the QR code now on the screen. You can also visit our YouTube page and type in McCabe Gunn in the search bar and we'll pop right up. We keep all of our prior presentations available there as well. And if you subscribe, you'll be notified when we do our next upload. Starting in 25, kind of a quick run through the One Big Beautiful Bill items, especially as you're thinking about year-end tax planning. Starting in 25, these are the ones that take effect now. Senior 65 or older with less than 75K of adjusted gross income for single or 150K adjusted gross income married will receive an additional $6,000 standard deduction, if you will, for each. This provision does expire in 28, though. Next is the increase in the state and local sales tax cap of $40,000 for incomes less than 500K. Again, this starts in 25 and it'll increase 1% per year through 29, and then it reverts back to the 10K limit in 2030. If your income is over 500K, if you're ever so lucky, you'll still get the 10K. For those on the border of itemizing, this could be very, very good for you, especially when you start adding in items like the new auto interest deduction. And again, we'll cover that in a second. Regular charitable contributions above the new 0.5% contribution base. Yes, there's an itemized charitable contribution base starting in 26. And once that's prescribed, we'll let you know what that is. For the auto loan interest deduction, though, it is up to 10K. The auto must be a new U.S. assembled passenger auto purchased in 25. Of course, later you can buy it 26, 27. And that deduction is available through 28. So if you're looking to finance a new car this year, now might be a good time to do it. Deduct some of that interest. No tax on tips in overtime starts in 25 again. It ends in 28. For tips, up to 25K per year per person can be earned tax-free, but with a phase out beginning at $150,000. There are no phase outs for the overtime, no tax on overtime, but it is limited to $12,500. One of my favorite updates is the non-itemizer charitable deduction. Now, I just throwing this out there. It doesn't start until 26. It's just one of my favorites. They had this back in COVID. They allowed $600, I think, for 1 year, but it allows folks to get up to $1,000 deduction, $2,000 for married, starting in 26, and it's permanent. I think that's great. So keep your Goodwill receipts as you start donating your items now. You can actually deduct those things. Lastly, the estate and gift tax exemption will not revert back to the 2017 levels and will be increased to $15 million for single filers and $30 million for married, starting in 26. While we would never advocate to delay updating your estate plan, the urgency to do so because of a reduction of lifetime exclusion limits is no longer a factor. So if you didn't know that, you probably did by now. Take a deep breath. No big rush to get things updated for the end of the year. All right. That's it on the One Big Beautiful Bill. Hopefully you're doing your tax planning. You know where to find us if you need help along the way. Marshall, I'll turn it back over to you. I think next up is interest rates.
Yes, sir.
Awesome.
Critical driver of U.S. borrowing costs are the 10-year treasuries. The 10-year yield has declined slightly, 0.18 since last quarter, not too bad. And the driver of that, of course, is economic uncertainty and the rate cuts from the Fed. So this was as of yesterday, not reflecting the Fed rate cut. So as much as Chairman Powell says that it's not the driver, it's a driver, no question about it. So as a result, that 4.2 will probably decline below 4%. The Wall Street Journal reported yesterday that 30-year mortgages are now at 6.18%. That's a very solid decline, almost 0.5% since where we were in July. So that's really great. Good to see those home mortgage rates coming down. For most of the people on this call, 6.8% we would have thought was a steal during our lifetime of purchasing homes. But remember, we now have a generation that got a taste of 2.25%, 2.75%, or 3%. So 6.18 seems horribly pricey. Again, if you've been around a while, you know that, boy, that ain't bad. At any rate, hopefully we'll see a little improvement in mortgage interest rates, and we'll see some better home activity, home purchasing going on. So home prices for the moment, though, have held steady. Mortgage rates, of course, were steady. So Q3 was not a hotbed of activity. A lot of people on the sidelines want to move, but hate to give up those very, very low interest rates. Activity's nowhere where it was in recent years, and the culprits, of course, are the increased interest rates. And there was a problem with supply, but supply seems to be picking up. And so we may see some better activity in this. I'm looking at 2026, not necessarily Q4. For mortgage rates, of course, we've got that 10-year Treasury there, and we'll continue to monitor that in the coming weeks to see if this Fed rate cut does actually impact it. We expect it will. Shawn mentioned about the consumer confidence. We've got the consumer confidence index from the Feds. This is from the Bureau of Labor and Statistics. As we got through September, you've seen very little change going on. The Michigan study that Shawn used usually gives you a more current, better representation. They tend to be a little broader, and as unfortunately we learned in the recent months, they're a little more accurate. So the real test is going to be holiday shopping. How much have tariffs impacted the toys at Walmart and the electronics at Best Buy? That's what's going to really tell us about consumer confidence, and will the consumer continue to spend money? Despite the slight declines that we've seen in leading economic indicators in August, for what I look at for the June to August and probably September, we don't know again because the government's closed, the LEI continues to remain steady. So even though the consumer may not be as happy with what's going on, the real economic indicators are holding steady. The interesting thing is that during the presidential campaign, the LEI dipped more than we've seen since the tariffs of 25. So it'll be interesting to see how all this plays out in the coming months. So to summarize, as Shawn and I are trying to present, the media and the consumers are feeling that the economy is worse than it actually is. So I'll just leave it at that. I couldn't get away without just mentioning tariffs. Gosh, it's frightening because you sit here and the market's clipping along really well, and suddenly you hear that some countries' tariffs are being increased, and the market falls 400 points. Of course, it rebounds in the next couple of days and recovers, but it's just unsettling. So that's another reason why we try to keep our clients very diversified, is because you never know which industry that's going to impact, whether it's going to be tennis shoes or whether it's going to be electronics. You just don't know. So you have to be always attentive to what's going on. The U.S., of course, is a net importer of goods, but a net exporter of services. We're not tariffing, if you will, services. We're tariffing goods. We import the clothes, the electronics, the cars, the industrial materials, and then we export things like software and financial services and telecommunications. Add them together, and if you look, we're running at a huge trade deficit, have for decades. So really, the tariff is simply a consumption tax on those things that we like to buy and enjoy. And obviously, this gets passed on to the consumer. The burning question is, what is the long-term market impact? Chairman Powell yesterday said that it will actually take several quarters to identify the impact of tariffs. Now, that's really in contrast to what we heard at the end of the first quarter, when tariffs were really being announced and the market was getting it. You know, remember, as I said in the opening today, the market fell 20% because of tariffs, because the media told us that the world was going to come to an end because of tariffs. Well, we're 6 months in, it hasn't come to the end, the market's recovered, the market's grown. So I think the consumer is giving us the reality that the impact of tariffs will be determined over a longer term and not as dramatically as originally expressed. So that brings us to investing in uncertain times. always. Treats, no tricks. We don't like tricks. Then the following is not a recommendation to buy or sell. These are just presented for information purposes only. I start out, always do, with what's happened to the S&P. If you drew a linear line on this, it would really be nice. But you have periods when there are drops, you have periods when they're recovered. You look at the trend continues to remain solid. These numbers are actually through today's Thursday through Tuesday. So they're current numbers as to what is happening in the marketplace. The bull market trend continues. One of our registrants asked the question when we love getting our questions in advance. I'm going to address this one now because it's a good one for this slide, and it's, are we due for a correction? Well, keep in mind, corrections or declines of 10% or more, but less than 20. We got one earlier this year, and odds are good we may have another one before the end of the year. They're just part of the normal process. They are buying opportunities. Keep in mind, bear markets are declines of 20% or more, and recessions are shown in gray on the slide. We will have these fluctuations. So how do you protect yourself? Ta-da! Diversify. First time you've heard this presentation. Don't get complacent. As always, I apologize for the busyness of this slide. I had a great opportunity to sit with one of our attendees during her fall review the other day and print this out and walk through it line by line with her. It was great. So one of the things I learned in that was focus on the color. So if we're looking at that top right-hand column and we see emerging stocks, emerging market stocks have just been smoking the first part of the year. But if you look at that color down below, they lost 20% in 2022. So you recovered a portion of that investment in 2023 and 2024. So while they were terrible in 2022, it's taken you 3 years to get back to where you once were. The foreign countries have done well this year, but that 25% was 4% last year. Growth stocks, well, that's where the hot tech companies are. They're at 17% this year. We're seeing that little slowdown, but look at last year. There were 41 in 23 and 32 in 24. That's pretty hot. So you have to be careful playing the hot hand because today's hot hand can be a piece of ice tomorrow. You never know. The key is to keep a diversified portfolio that meets your risk tolerance and goals. Notice how an asset allocation, the white allocation in here, has generally been good and returns dollars virtually every year. So, if your target is to be right at double digits, you probably won't have a year that disappoints when you look at the last decade in there. I think, well, we have a couple of years that didn't quite. But 7 or 8 out of every 10 years, you meet your goals and you keep going. If you're one of the investors who are anticipating a bubble in the market, again, a well-diversified portfolio is your best defense. You won't get the high, but you won't get the low either. But Shawn, as we all know, there's always a reason not to invest in the market. Why not just sit on the sideline and earn my falling sub 4% money market account?
Very good question, Marshall. The easiest answer to that question right out of the gate is if you look back to my slides on inflation, you're falling sub 4% return in your savings account will not spend 5, 10, 15, 20 years from now what it does today. So you're actually losing money just sitting in cash. And that's the easiest one to look at. And I actually love this question. I tend to get it quite often. We both get it quite often. So if you're one of those folks thinking, hey, this market is getting a little too hot and is bound for sell-off, I'm telling you, you're not alone. And you're probably right. Marshall, you alluded to that a couple slides ago. However, I want all of us to take a moment and ask ourselves, would I be okay missing out on a 9.1% return in the next year, or a 27.5% return in the next 3 years, or even a 48.7% return over the next 5 years? The answer is probably not, right? And again, these are figures on this slide. This chart is showing average returns after the S&P 500 hits an all-time high. Okay. While there are certainly many down days mixed in after reaching all-time highs, investors should choose, we should all choose to hold steadfast and stay the course. I love that saying. What helps us all do that is, number one, knowing what we own. Number two, and I'd probably say more importantly to knowing what we own, is why do we own those things? And how can those things get us to our goals or maintain our goals? And then most importantly, number three is ignore the noise and trust your allocation and diversification. Marshall showed you why, because it helps you manage risk adequately enough so you sleep well at night, right? So I want to bring us back full circle as we bring our update to its close. I always want us to remember, hold steadfast and stay the course. No caveats, nothing else to that. As long as you have a good diversified and well allocated portfolio and you know what you own, you know why you own it and how it gets you to your goals, be done with it. You're in a good spot. So Marshall and I started this segment. We call it the Financial Planning Action Quarterly. You know us CPA nerds love our acronyms. Marshall picks on me. It's probably not CPA world. For me, it's probably the military still in there somewhere. But several quarters ago, we started this to raise awareness about a financial planning issue or other topic of interest we think you need to know. And this one's been kind of on mine and Marshall's hearts for a little while now. I think it's a great time to do it, especially starting in the holiday season and things start picking up and we start losing focus on, a little more focus on, paying attention to the business world or our emails or whatnot. So this quarter, I really want to touch on cybersecurity. Too many of my family, friends, and clients have been duped. We've been hacked, accounts hacked, Facebook, social media accounts hacked, all that. Hacking accounts and stealing people's money is a multi-billion-dollar industry. All right, these guys are making a lot of money stealing from us. And I think once upon a time, we all have, some of us just might not know it yet, have been hacked. That being said, the anxiety associated with an account being hacked, like an investment account or your identity being stolen, is off the charts. Marshall, you see what I did there? So here are the top 3 things you can do to help avoid it. Number 1, please, I beg you, implement multi-factor authentication. Yes, it's a pain in the butt. You just want to go to your websites or whatever and plug in your Google saved password and get right in the account. But if it's a financial account, I highly encourage you to put on multi-factor authentication. It's worth it. And what this is it provides an extra layer of security beyond just your password. When you enable multi-factor, you must provide a second form of verification, such as a one-time passcode sent to your phone before accessing an account. There are other services where they provide a 6-digit PIN or something like that. But either way, as long as you implement MFA, you're giving yourself the highest protection you can right out of the gate. And if you haven't done this already, please at least put it on your financial accounts. Number 2, practice strong password hygiene. Yeah, sounds hygienic, doesn't it? Use unique, complex passwords that are at least 12 characters long and include a mix of letters, numbers, and special characters. Use a password manager, right? A very secured one that has multi-factor authentication in it so it can't be hacked. Please don't use sticky notes under your keyboard, my wife, or little black books in your desk drawer. Having strong passwords can help create security and store those unique passwords, again, in a password keeper or something like that. So try to avoid repeating passwords across multiple accounts, which that helps isolate any potential breaches. So if one account gets breached, it's not your whole life that gets breached. And I know a lot of us have a hard time remembering that. Again, use a password keeper. If you want information on that, let me know. I'll give it to you. Try not to repeat or at least change, your numbers and information at the back of your passwords. All right. Number 3, identify and avoid phishing and social engineering scams. All right. This one's near and dear. It's so easy today with AI for people to get duped and hacked. Please educate yourself on what's going on out there. So it gives you that pause before you click that link or you respond to that voicemail you got that sounds like your own kid begging for money. Please educate yourself on how to spot suspicious emails, text messages, and phone calls. Scammers often use a sense of urgency to trick you into revealing sensitive information. That's what they want. They want to hack you. They want your information and they can use it to dupe your friends and steal their information. So if you receive an unusual request for a transaction or personal information, the best course of action, and this should be always and forever, is hang up, call the financial institution directly using a known trusted phone number, not one provided by the suspicious message, and deal with them directly. Never respond to emails, texts, or phone calls unless you know for sure. Always be in control of that communication. All right, so that's it. If you'd like more resources on this or want to talk about how we keep our data safe, don't hesitate to reach out. Marshall and I would be more than happy to share this information on a one-on-one basis. And so, yeah, thank you for tuning in today, and protect your data in your portfolio by following these 3 tips and turning off the news. See y'all next quarter, Marshall.
Yes, sir. Well, if some of you have some questions, feel free to type them in the chat box. We'll be glad to answer those. We've had a few that have actually come in earlier. And Shawn, you touched on a little bit, but I'm going to ask you to field one for me. What were the changes in the big, beautiful bill impacting capital gains? I think this is a client who's considering trimming some of his portfolio before the end of the year, and feels he's out of balance. So you want to handle what the big, beautiful bill do to capital gains?
Marshall, my focus has been on the points of interest I covered earlier. You caught me off guard on this one. Can't think off the top of my head. Do you?
Well, I think the answer is nothing.
Okay.
The fortunate side is, in the prior administration, we heard all sorts of threats about taking it from 15% to 20% or 28%. And it got locked in now at the 15%, and your first almost $50,000 could be tax-free. So the current administration is very pro the stock market, in case you hadn't noticed that. And as a result, the capital gains rates remained extremely favorable for long-term capital gains as well as qualified dividends. So good news, no changes.
Okay.
One of our other registrants typed in, Marshall, gold has been rising substantial recently. Shouldn't I be buying gold? I hear it is a safe investment. Well, we've watched gold and other precious metals over the years, and the best I can tell you is I'm going to rely on a guy who seems to be fairly wise. It's a guy named Warren Buffett. He was asked for a response on precious metals, and I'm going to include Bitcoin for this discussion. And his comment is they are, quote, a bigger sucker investment. Since they don't have a stable value fluctuation, they don't pay dividends, you have to have a bigger sucker waiting to pay you a higher price, interestingly enough. So gold has been one of those security type investments that, hey, if I've got gold, I'll always be able to buy things. But I always wonder, if you walked in with a gold ingot to Publix and handed that to that really nice cashier, they're probably going to look at you with a strange eye. So in an electronic world, I'm not sure that that's going to work. However, I must caveat that a recent discussion with a client, I'll just refer to her as Amanda, not her real name. She has an appointment with a jeweler to explore investing in gold as jewelry. She feels that's a very wise and safe investment. So, to each his own on the precious metal world. To close, always build your investment portfolio with companies whose profits are not tied to politics. Look at, we've seen General Motors drop out, and we've seen the challenges for Tesla as a result of some of the credits, the energy credits going away. So again, that's tied to politics. So regardless of what happens in the economy or in the White House, keep in mind, people continue using Charmin, eating out, taking their drugs, and using their cell phone. So I want to mention from a social media standpoint, because we do make posts during the quarter. Shawn's really our better one on that, but you see the QR code in the top right-hand corner. Please join us on social media. We appreciate being one of your resources. We do have a question in the chat box. After data leaks such as AT&T, is it a good idea to use a data security company like Ari or Norton? Shawn, that's your strength area. You want to hit that one?
Absolutely. I can't particularly recommend a specific company, but the probability of some of our data, and I mean all of us, our data being leaked and exposed is super, super high, probably 100% in some way, shape, or form. You probably will never be able to protect 100% of your data. So the real answer to that question is, how can you quickly identify a breach and then be protected in the fact that you can go and identify it and change your data quick? And that is done through data security software. If there's a breach out there, you want to know. So make sure you're tracking your credit, especially from the financial side of things. There's free services out there. And then make sure, to your point in the chat, that you do have some sort of data security in place that will alert you if there is a breach, so you can go change your passwords. Great question.
Thanks, Shawn. Well, that seems to be the only one in our chat box today. So obviously, thank you for attending. I hope you have a great Halloween. If you know someone who would benefit from our webinar, we'll be offering a recording of today's presentation on the McCabe Gunn YouTube channel. Once it's posted, you'll receive an email link as long as you register today, and obviously you did if you're here. As always, feel free to share it with your family and friends. Don't see any final questions from our audience. So our next scheduled event will be our annual economic update, and it will be held on Thursday, January 29th at 10 a.m. Thank you for joining us. We look forward to meeting with you again soon, and just have a wonderful Thanksgiving, happy holidays, Merry Christmas, and look forward to getting back with you in 2026. Take care.